Good evening and welcome. This is Campbell Venning from the Property Factory, and I am your host for this webinar tonight. Now, I always like to check that people can hear me. So if somebody could send a message through the Q&A box just to say, yes, I can hear you, Campbell, that would be wonderful. And Nathan, thank you very much. I only need one to let me know that, and Matt, good on you guys. Thank you. So tonight's webinar, and Happy New Year, everybody, and I hope you had a safe and enjoyable Christmas, New Year, and holidays. And I'm sure, like everyone, it's a bit of a culture shock to come back to the monotony of work, which funds the next year's holiday. So that's the good news. Everybody gets to have another holiday in 12 months' time in terms of extended holiday. So thank you for that. Somebody's asked me to speak up a bit. Maybe check your volume on your speakers as well, Summer, because sometimes that can be an impact on you as well. So if your volume's down, my voice will be low. So I can see more and more people logging in, so I'll just talk generally for a while. Whilst my holidays were amazing, I'm actually looking forward to getting back into work. Maybe there's something wrong with me, but you get to the point that you can only lie on the beach for too long or hang around with your mates socialising for so long. So I'm looking forward to this year, and I'm expecting to be busier than last year from a whole bunch of perspectives. So so I'm going to get into it in a minute. I'll just wait for some more people logging in. I can see now we're up to probably half of the people that who have registered. And look at these nice people. Oh my, look at God! Thanks, Claire from Property Factory and Gabs from the Property Factory. Chris, one of our partners. All can hear me. Good, thank you. Basically, first webinar of the year. This is going to be quite a short and sweet one. And we're going to be doing more online. We're going to be doing more face-to-face. So this is really an opportunity, just a quick snapshot, quick hotspot, quick look, talk about the stock that we've got coming up, because we get that asked all the time, and a few other things. So I will rip into it now, as long as my slides are going to click forward. Here we go. So often, and I'm sorry for the people that have been to these before, but we do need to welcome new clients into the business. So we take this opportunity to talk to them about who we are and what we do. I'm going to talk about the Christchurch and Auckland markets, specifically the latest projects that we are working on, or that are live now, and the ones that we're working on. And for the newbies, next steps about working with us and how you can work with us to achieve your property investing goals, or your goals of getting into property. So who are we and what we do? So very short, because this can, when we're in the room, this can often take 30 minutes. So I'll try and make it less than 3. So we are a business that is looking, first of all, can people see the screen? I'm assuming you can, but can someone just tell me you can actually see the screen? I think Nathan said yes. So I hope you can see a picture of a middle-aged, balding man with glasses there. But if someone could just double confirm that you can, that'd be wonderful. And it's yes, thank you, Roxanne. That is good. So, okay, back to the Property Factory and what we do. We're a solution for builders, developers, and vendors who need volume property sold. We're also a solution for investors as a very easy one-stop shop to satisfy all of your investing needs. Our goal internally, and I think we've been meeting this goal, is to provide better opportunities that are available just sort of out there when you're driving around and you see a for sale sign. And I guess we're doing something right, and we need to update this, but we are, I think, now up to 2,300 properties over 25 years now that we're into 2020. So we've hit the $1 billion mark. For some reason, 950 million sounds like a bigger number than $1 billion. billion sort of almost an unimaginable number. But yeah, we've been doing this for a long time, and our combined team have over 50 years of experience. And whilst we're a solution for property vendors, builders, and developers, we're also a very member-focused, customer-focused business. And if you're a member of ours, and it takes about 2 minutes to become a member, you get access to opportunities only our members get. And that might sound like a loose promise or opportunity, but if I look at the deals that we negotiate, I think the largest equity gain that we had for people last year was about $86,000. That's $86,000 that they gained through working through us on one deal. So yeah, it's not a token offer, and we've made it free because we've set our business up in a way that we can deal with volume. And we've been recruiting for the last 2 months. And if you're listening to this as a customer and you'd like to get involved in real estate as a business, please email us, because we are still recruiting nationally. And ironically, the place we need people the most is Auckland. So if you're sitting there in Auckland and you would love to do property as a job or a business, because we've got opportunities in both areas, please email us, and the email will make its way to me. And yeah, I'm on the road at the moment interviewing and recruiting. So we're pretty excited about 2020 at the Property Factory. We've been around for a long time. The factory is my fourth property business doing the same thing. We reinvent ourselves every few years, and those transactions are spread across those 4 different businesses. However, it's effectively the same business. Someone's actually asked me if they need to have their real estate papers to work for us. The answer is no, you don't. If you haven't got them, we will help you get them, Kelly. So yeah, if you're looking for an opportunity to get into real estate, and when I say real estate, I'm talking more investment sales, not just working for a stock standard real estate company. That's not us. We want people that understand numbers, who can articulate numbers, who can do cash flows, etc. So yes, you will need to do real estate papers, but we help you facilitate that because it's a pretty straightforward process. Okay, where's my mouse? Right, so and this is a really short version of what we teach, because what we're going to be doing in February is updating all of our statistics, all of our assessment of the market. But one of the things that we really are pushing to customers is to really understand property cycles and property clocks. And property is cyclical. What does that mean? Well, it means that every 7 to 10 years, property goes up, goes flat, can go down. But if you look at New Zealand over the 130 years of the property market here, property's gone up on average per annum at about 7%. Now, it doesn't go up 7% every week or month or year. It goes up, down, sideways. But if you look at the long-term average, it's about 7%. And there are markets within markets. So Auckland's at a very different stage to, say, Dunedin, to, say, Wellington, to, say, Auckland, to Christchurch. So there's markets within markets. But if you look at property cycles, you can use what's called the property clock to assess where a property location is at. And 12 o'clock, prices have peaked. It's a time to sell if you're a trader. It's time to consolidate if you're an investor, because you're in for some quiet, slow, flattening prices period. So after 12 o'clock, we move into an oversupply situation where supply exceeds demand. That can often have an impact on prices where prices drop or stay steady. The old saying that property is always going up is absolute rubbish. It's not always going up. Over the long term it is, but over the short, medium term it can go backwards, it can go flat. So when we have oversupply, that can mean falling or flattening sales. It can also mean falling or flattening prices. That then leads to builders slowing down. Can developers slowing down, so falling construction can happen. And then we have this, what we call the bottom of the market. And at the bottom of the market, prices have come back, or sale volumes have come back, and we have this period of flattening prices. And if I look at the country right now, Christchurch, in my opinion, is at 6 or 7 o'clock in most locations, not all locations, but in most locations. And I'm generalising. But if I look at Christchurch investment market, I can't see prices getting any lower. In fact, if anything, in 2020, I'll be absolutely blown away if prices don't go up. I'll be shocked, I'll be surprised, and I just don't believe it will happen. But that's just my opinion. So at 6 o'clock, it's the time to buy. And at 12 o'clock, if you're a trader, it's the time to sell. If you're an investor, it's the time to sit on your hands. So then we get to 7 o'clock where we've got undersupply, and after the two biggest sectors, or the two biggest markets to bring us out of a flat period, are property investors and first home buyers. And that's what we do. We deal with both markets. So in a Christchurch type market, in some categories there is undersupply, and it's anecdotal. You can do the math, you can do the stats, you can look at the economics, and we are undersupplied in certain sectors. We're oversupplied in other sectors. In the retail space, if you're a bar or a restaurant, there is a lot of supply, so you're oversupplied. You're at 1:30, 2 o'clock. But let's go back to residential property, brand new. We are undersupplied in Christchurch for that market, which is growing. There's currently between 6,000 and 7,000 people living within the 4 Avs, and the forecast is for that to rise to 20,000. And we do not have another, 15 to 20,000 properties to house those people within the 4 Avs at the moment, and which is one of the reasons why developers that are building or selling apartments and townhouses off the plans within the 4 Avs, the reason people are buying them is that there is an undersupply. So what happens then? Prices start to move forward and start to go up. And at 9 o'clock, rising sales, rising sale volumes, rising prices. And we're starting to see that in some sectors in Christchurch, rising construction, and then we do the cycle. So this doesn't all happen in 12 months. It happens between 7 and 10 years. Christchurch, funnily enough, has been a market on its own where the whole formula has sort of been thrown out a little bit, because we had such a catastrophic earthquake here that it's affected so many things, and the rebuild cost is going to come in way more than expected. And it's not an unknown market. I mean, earthquakes have happened before in other countries, but it's an extremely rare market that doesn't happen very often. And I guess if you're a property person that knows what they're doing, you can actually work that to your advantage. And if you're a trader, you try and buy at 6 and sell at 12. If you're an investor, you reinvest at 11 or 12, and then focus on getting your portfolio sorted out. And it's amazing how often people do the opposite. And the fact that you're on this webinar tonight, you're not the normal person in the market. You'd be surprised at how fickle most property investors are. And ironically, they don't typically buy more than one, maybe two, because they buy the wrong property in the wrong location. They do it because their neighbour told them it was a good idea, or they read something in the news that said we should get into the market. And it's completely an ill-informed decision. It's a total uneducated play, and it can often ruin people. So the people that join our business are people that want to know how to do it. They want to learn from experienced people, and they want to do it properly. But that's not the 80%. It's probably the 5%. The 80% wander into a market and they buy at 12 and they sell at 6, and they've got no idea. And I see them every day. And as much as I want to cure them, it's a bit like an alcoholic. I mean, you can't do it for them. They have to do it themselves. And it's surprising the amount of times I hear property experts who are complete half-wits. They think they're experts because they've read 3 articles in the press And it's scary, but it's what happens. And that's one of the reasons that we have prices peaking. That's one of the reasons we have oversupply. Developers that release 300 sections in one hit and wonder why prices go backwards, that's not rocket science. They've oversupplied a market, whereas smart developers will stage a subdivision. They'll have 5, 10, 20, 30 stages. So property is a learned industry, and you need to know what you're doing. And if you're first or new to it, you can learn from others, but you have to find the right people. And I guess that's what we are at the Property Factory. We're a very experienced property team. I bought my first property nearly 30 years ago, and I made some mistakes and I learned from them. So we hold our clients' hands right through the property journey, because we're not just trying to sell property to people. If we're doing our job, we'll have a 7 to 10 year relationship with people. So yeah, that's a quick background on us. I can see you've got more people here. There's a few Q&As. I'm going to stop for an question and answer session in a minute. So we like to give people a market update. So these are fresh off the press, the statistics, and this is where the media is a good place to get updated stats, because if it's a statistic, it's not coming from the media, it's coming from the industry. Whereas if it's an opinion from some journalist, and don't get me wrong, I've got some friends that are journalists, but if it's an opinion from a journalist that doesn't own property, press delete. So these are stats that came, current stats in New Zealand, and the annual median price changes around the country, everything's on the up. And some places more than others. But when I say everything, nearly everything, and there's a few small towns that are going backwards for various reasons. But if you look at the green arrows there, you can see that New Zealand's up 12%. 31 days is the average or median days to sell, and that's low, that's short. And even places like Northland at the top of New Zealand, 12% growth in the last 12 months in terms of annual price change. Gisborne, 21%. And it's the regions which are really pushing it at the moment, because a lot of people now can't afford the cities. Manawatu, Wanganui, 28% nearly. And that's a massive jump. And in some eyes, it can be scary, because that's pushing towards the 12 o'clock. It gets further south now. Wellington up 11%, Hawke's Bay 14%. Look at old Canterbury, 1%. So what's wrong with Canterbury? Was it toxic? Has it got the coronavirus, or the what's wrong with it? And I'll talk about that as we get into it. Southland 32%, but West Coast minus 13%. Now the problem for the West Coast, and I actually do own property on the West Coast. I have a share in a whitebait stand. Now we don't own the land; we own the lease to fish the river. But the trouble with the West Coast is that most of the population down towards Franz Joseph and Fox Glacier is on an earthquake fault, right on it. It goes through the middle of the main street. And that has an impact on Hokitika and Greymouth and all the other West Coast towns. So those property markets have always struggled because of that. And it's not like population's rising off the back of industry. So it's quite understandable. And 13% when your median's 190,000 isn't a huge amount of money. Whereas 13% when your median is a million or 500 or 600,000 is a big difference, is a much more larger impact, because the other thing is the volume of sales on the West Coast is tiny compared to, say, Christchurch or Wellington or Auckland. So you've got to look at, when you look at macro numbers like this, these are macro numbers, often the story at the micro level is quite different. But all in all, New Zealand's on the up. And when I see the second largest population base in the country being Canterbury, when I see Canterbury now cheaper than Marlborough, when I see Canterbury a lot cheaper than Otago, I just think that's crazy. I just think that's mental. I mean, how on earth can the only other city in New Zealand with an international airport that's open 24 hours have a median house price of 460,000? And the answer is the earthquakes. But those earthquakes are coming up for their 10-year anniversary. So Christchurch is a very different place to what it was 3, 5, 7, 10 years ago. And I think one of the things you're going to see more and more in the media, which is not where we take advice from, is a focus on Christchurch, a prediction that it's going up, an anticipation that it's going up. Because an international city like Christchurch, in a relatively flat location like Canterbury, doesn't make sense when you look at the national average being 620, or the median price. We're going to be careful with stats. It's not the national average, it's the median price of 629,000. 460 in Christchurch or Canterbury is just too low. So let's look at this in real dollars and real sale volumes and days to sell. And we're going back 2 years now. We're going to compare 2018 with 2019, because one of the things about looking back, it allows you to make predictions going forward. And this is, I mean, I've been through 4 property cycles. The first one, I was a young fella watching it through the eyes of my parents, but I've experienced property ownership in 3 property cycles. So hitting my 51st year in January this month, I guess I'm starting to get long in the tooth, and I don't want to say it's as easy as predicting who's going to win the Rugby World Cup, because it's not actually that easy to predict, as we saw last year. But I do think property is pretty predictable, and as long as you hedge your bets and diversify, I think it's a relatively safe and easy business to predict once you start spending time, money and effort on metrics, being statistics, reading markets, getting knowledgeable, and just becoming, a smarter property person. I met with one of my wonderful clients today, who is they're buying. They've got a goal of buying probably 7 to 10 properties in the next year or so, and they will. And their judgment's getting better and better. And they were new to it last year, and they're getting better. So let's just look at the sorts of things you should be asking yourselves. And I'm going to compare Christchurch to Auckland. So let's just look at the more micro numbers now. So the median price in Christchurch in 2018 was 451. Now it's 460. Bugger all change. Not even 10 grand. The number of sales was 6599 in 18. Now it's 6792. Up a little bit. Who cares? Not much of a change. So it's flat in terms of change. Still a lot of sales. Days to sell, 36 to 35, neither here nor there. But volume and price is increasing, days to sell is reducing. So that's a flag. It's small steps, but not all markets jump 30%. If I look at the December quarter, 465 to 475, 10 grand. 1787 to 1890. That's a bigger increase than 12 months. 34 days is now 31 days. So we're putting Christchurch at 7 o'clock, and we are just telling people it's the time to buy. It's the time to buy here. And I moved here this time last year, and I'm not telling people it's time to buy because I moved here. There are lots of places that make sense to buy, and it depends on your existing portfolio, where you live, how much money you earn, etc. But in terms of Christchurch for cash flow, it is the cash flow here is going to go down as prices go up, and the people that get in sooner are the ones that win. And the amount of times I've had sad investors who missed out on a property and it's gone up in price, it happens more often than you think. So let's look at Auckland for the same period. In the last 12 months, 890 to 890 median price, flatlined. Volume of sales or number of sales, 898 versus 226. It's gone down. Days to sell has gone up. Volume and price has been flat, so the days to sell is increasing. That's scary. That is scary from if you don't know what you're doing, that's potentially, sliding. However, if we look at the December quarter, 860 to 875, so there actually has been an increase. Number of sales has increased quite significantly, from 5896 to 6473, and the days to sell has dropped. Now, there's a famous saying in economics. It's called a dead cat bouncing. Now, I don't think Auckland is a dead cat bouncing, but a lot of people's assumption is that the market here in Auckland is at 6 o'clock. Now, there is a market in Auckland that's at 6 o'clock, and it's called infill housing, higher density properties. We've got clients that we're working with very closely at the moment in Auckland who are helping solve the housing crisis, and it's the product that's well under that median price. And I call it the new product of Auckland. Infill housing, Auckland Unitary Plan allowed this, smaller land sizes, smaller houses, and we're selling these properties with 4s, 5s, and 6s in front of them, not 8s, 9s, and million. So in this market, it's at 6 o'clock. The Auckland market is arguably at 9, 10 o'clock, because when you see a median price of 890 or 875, it's good that it's coming down, but it's coming down because people are starting to move to smaller and cheaper houses. And in the world of investment property, take a hell of a lot to convince me that a $900,000 investment property in Auckland with one income stream coming from it is a good investment. I'd take that Pepsi challenge with most people, because not many people can afford the rent for a $900,000 property. Well, not many people can actually afford the mortgage for a $900,000 property. Now, Auckland is our engine room. It is our epicenter. Incomes across Auckland region are the highest in the country. Wellington City has a higher income per capita than Auckland City. But if we look at Auckland as a region, a lot of people can support $1 million mortgages. However, the mass market can't, not on average incomes. So you've got to be careful in Auckland. And right now, it's laser focused stuff. It's looking at the markets where infill housing, Auckland Unitary Plan, gentrification of suburbs is going on. So that's just comparing two markets, which are very different stages, but same comparison in terms of you go through the same process. So I'm just going to have a pause. I'm just going to mute myself because I'd like to get some questions. So if you have questions regarding this, because this is the boring stuff that can save you money and make you money. So I'm going to put out to the audience now for a couple of questions. So let's shoot. I'm still waiting. No one's got a question. I'm going to keep talking. But please, there's basically a little box that says Q&A. Click on that and you can ask me a question and I'll answer it. So I'll move on. But please digest all of this information that I'm giving you. I've got a raised hand. I don't know what that means. I think it means, how do I ask a question? Click on the Q&A box. Oh, good. Thanks, Tim and Ian. Right, Tim. What about returns and vacancy rates? What about returns, rental returns and vacancy rates for each city? Great question, Tim. Ian's asked Campbell, do you have an indicator on average rental comparisons for Auckland versus Christchurch? So these two guys, I'm assuming they're both men, have asked good questions, because regardless of your entry price, regardless of your supply of property versus demand of tenants, you need to get income or rent to pay the mortgage and to live off. So in terms of each city, there are suburbs in every city in the country which has vacancy, higher vacancy than other suburbs. If you look at Wellington Central, it has one of the lowest vacancy rates in the country, because it's a very difficult place to build new property in, because you've got a harbour on one side, you've got hills on the other, you've got very expensive land, and you've also got very expensive land to build on, as the BNZ found out when their brand new building down at Centreport is currently being deconstructed after the Kaikoura earthquakes. So right now in Wellington, massive undersupply of residential property, which has had huge impact on rental rates. Now, don't all rush into Wellington, because it's very expensive to buy. It's almost twice Christchurch, which doesn't make sense considering it's a smaller city and a smaller region. So we look at vacancy rates in each city by suburb, because some suburbs, you wouldn't go there for a lot of different reasons. So vacancy is critical because you can get the great, like I'll pick on Tokoroa. Tokoroa has awesome yields, but vacancy rates are one of the highest in the country. So your yield's only relative if you're actually getting the rent. So you can get a property that's advertising a 12% yield, but it's not real because the property is often not rented for 12 months. So rental returns are not just about the percentage, they're actually about rent being banked. So coming to Ian's question, he's asked about, do you have an indicator on average rent comparisons for Auckland versus Christchurch? Yes, that information is public information, Ian. You can get it from a few sources, New Zealand Property Investor Magazine, Housing New Zealand. We don't publish that information on our website. We're going to start putting more statistics on our website, but again, it's time and money. We're relatively under-resourced at the moment, hence the recruitment call at the start of this webinar. But the one thing Google has given us is an open source data. And if you Google average rental comparisons, Auckland, Christchurch, you'll probably find QV or Core Logic or Department of Stats or Housing New Zealand will pop up a beautiful little graph and or some charts. Just do some digging online. You'll be amazed at how much information is out there for free. Okay, an anonymous attendee has asked me that they have heard insurance in Christchurch is hard to get. How accurate is this? It is completely inaccurate. And right now, insurance is way harder to get in Wellington than Christchurch. And if you'd asked that question a year, 2, maybe 3 years after the earthquakes, it was near impossible to get insurance in Christchurch. But that has changed now. Even old houses are getting insurance easily. I bought a 1920s house in May of last year for just under $2 million. And we got insurance in about 30 minutes. So insurance is not hard to get if you know what you're doing in Christchurch. And it's a very old and still published inaccuracy that the media love to dine out on. I'd be more concerned about Wellington. Christine's asked about body corporate fees vary so much. Why is this? Body corporate fees are basically forced maintenance, forced long-term capital spend. And the reason they vary is that developers that you don't want to buy off will underestimate their body corporate budgets, and people buy, and then all of a sudden the fees will jump. So we work with developers and we second guess the body corporate budgets. And I'm finding now that the body corporate managers that are out there are brilliant at keeping developers honest, and I'm seeing less variation. And if anything, we specialise in new builds. I think some of the body corporate fees are too high, but I like that because it means that the building complex will have money for unforeseen events. And body corporate fees are basically people looking after your property on your behalf in a group way, all for them. I think they're brilliant. And the ignorance around body corporate process is actually, again, typically media driven. But body corporates are a good thing, especially if you're getting into your 50s and 60s and you don't want to be hands-on. You've got other people looking after your property. So the reason that the fees vary so much, Christine, to answer the question specifically, is it depends on the complex or the development or the property type. When you've got swimming pools and gyms and lots of lifts, and everyone's got to pay for that carry-on. Whereas if you've got the 2-story complex with no lifts and just gardens to maintain, the fees are much lower. And if the building has been built with concrete or steel, they last longer. So it depends on the construction, the type of property, and a whole bunch of things. But at the same time, you blend that into the investment decision in general. So people who don't buy because it's a body corporate need to get re-educated. But when you are looking at buying in a body corporate environment, you just need to know what you're dealing with. Who's insuring as-is properties in Christchurch? And that's a good question, Claire. And as is, whereas properties is a specific type of property that we do not recommend people buy in Christchurch unless they are a professional investor or a habitual investor. So we don't recommend as is, whereas. I've been in the market here, since the earthquake. We were one of the first companies to get involved in the earthquake rebuild. I've bought and sold a lot of properties in Christchurch. I own 5 properties in Christchurch, and I haven't bought an as-is whereas, and I know what I'm doing. So be very careful with as-is whereas. The people that know what they're doing, they do a good job, but it's a business and a business. Okay, I am going to go back to my presentation because I'm running out of time. So let's go back to the macro picture, being the big picture. The light blue line is New Zealand and the dark blue line is Auckland. And this is over the last 20 years nearly, 20 years actually, well 20 years, if we look at now they're in 2020. That graph, I'm sure if you average, is 7% compounding, or the New Zealand line. Auckland is New Zealand's economical powerhouse. It's half the country, probably more. And what I love about the 2016 line to 2020 is that it's gone flat. Because if you go back to 2008, you can see a dip. If we zoomed in on that dip, it's quite a big dip. And most of the Auckland market, especially in the apartment space, was a much, much sharper dip than what you're looking at. But that's the dip for Auckland region. And it corrected. This is your cycle. This is a 20-year cycle. And you can see 2000 to 2008, it went up and up and up, and then it went flat, and then it went backwards, went down, and then it started going up again in 2009. And ironically, 2009 was the start of the new cycle. 2007, in July to be specific, was the epicenter of the global financial crisis. It was when the New Zealand property market tanked, and everyone in property, or most people in property, got affected by it. But we're not. What I like from 16 to 20 is that flat growth. The average price scares me, and that will start coming down with infill housing and gentrification, and I like that. So that's Auckland's 20-year growth. Let's look at Wellington's, the green line. I've never been worried about Wellington before as much as I am now. And we have clients ask us for apartments and townhouses in the city all the time, and we just say we can't make the numbers work. And people that just jump in there because they know it's a safe rental city, which is very safe, are typically buying on 3 to 4% yields, and it's too low. We just don't buy on those yields. So be very careful. You don't just pile into the Wellington market, because all of the retail investors are what I call the great unwashed, the ignorant, the uneducated, uninformed investors. They jump into that market as everyone else has, but they missed the boat. The time to do that was in 2009, not 2020. And we're going to start, or we have, we're selling property in Wellington right now, and it's all infill housing, unitary plan type properties where they're smaller, they're new, and developers are buying 4 houses and then developing another 10 or 12. And it basically resets the land value. Now, you don't see that in the macro picture here, so you've got to be very careful that you buy in the right location and you buy the right property type. And it's not secondhand. I would not buy secondhand property in Wellington at the moment. I would sell it. And I still own property in Wellington, but I sold a lot of my portfolio in the last couple of years there. It's dangerous. It's a dangerous market, so be careful in Wellington. And when I say that, we have good properties there, but it's very specific. Christchurch, ironically, was following the New Zealand national average beautifully until 2014. And what happened in 2014 was a lot of things. Basically, the residents of Canterbury agreed the master plan for Christchurch. Insurance scraps were rife. The reconstruction of the city. 80% of the Christchurch CBD, which is defined by the 4 avenues, 80% of the property within the 4 avenues was destroyed or pulled down after that earthquake. 80%. So just think about that and the time and effort and cost that must have taken. So in 14, things were happening in Christchurch, but you can't rebuild a city in New Zealand overnight. And meanwhile, the rest of the country, population increase, undersupply of real estate, the whole country just boomed away. And Christchurch was in the middle of a construction boom. And a lot of people made a lot of money in those early years, and they're still making money. But in terms of house prices, from rental, because remember, these aren't rental prices, these aren't rental stats, these are houses. And a lot of people have been stuck and still are in broken houses. A lot of people got bankrupted because their insurance company didn't pay them out and they had to walk away from the house. And then it's left with the bank. There were a lot of horror stories in 2013 to 14 to 15. And, you know, it's sad, but it happens. So Christchurch is a complicated market, you know, as is Werris. Keep away from it. But if I look at the infill housing, the higher density and medium density housing that we're selling, I don't know how it's being sold for the prices that we're selling them for, because I think if you started again today with the same projects, there'd be another 20, 30, 40% more. So prices in Christchurch, in my opinion, are stupid low. And we're pushing it as a location only because of these stats, not because I've moved back here. In fact, I lived in the North Island for longer than the South. But the stats just are crazy. And if we go back to Wellington, I said to a whole bunch of our clients in 2014, I said, you're all mad not to buy in Wellington. Prices are too low. And it was because yields were getting up. And this was in the investment world. I was saying you need to buy investment property here. And I went hard on Wellington in 2014 because the yields were just too high. I had 5 units in one complex at one point, couple in another. So, you know, I'm looking at Wellington in 2014 and saying that Christchurch in 2020 is in the same place. That's not sustainable. So, you know, I'm not guaranteeing it. I can't promise it, but I'm just giving you my 20 years of judgment. Sorry, 30 years of judgment. So if we look at the major cities, Wellington keeps going from strength to strength from a sales point of view. If you're a developer in Wellington, you can always write your own price. Auckland's flatlining. New Zealand's still going up nicely, not too steep. And Christchurch, as I've said enough times, is a time to buy. I'm just going to quickly look at questions, but I know that I'm behind now, so I'm not going to talk for too long. No, nothing really major. Ian's asked a very good technical question, but it would take me too long to answer. So Ian, look, send me an email, buddy, and I'll give you my views on that. He's talking about project overruns, weather tightness, and, you know, the cost of construction in New Zealand is just so high. And I've just finished a huge renovation in the North Island. I've finished a huge renovation in the North Island and a new build. And our new build went from 428,000 to 500,000. And I know what I'm doing, and that was just variations that we wanted. And that was just a brand new house on the beach. So, you know, there's a lot of good questions here coming through. So Ian, flick me an email and I'll be very happy to answer that. Otherwise, I'll be well over, which I'll get shot for. So what I'm going to talk about now is, well, this isn't a new release, but it was our newest release last year. So we had the fortunate privilege of being the first investment sales company that's been involved with Fletcher's in Christchurch. And they entrusted us with a brand new complex that's actually finished. So those aren't renders, that's actually a photo that I took. Brand new 1 and 2 bedroom townhouses. The 1 bedrooms we're selling for 330 to 385, the 2 bedrooms 430 to 470. These properties are just unique in the fact that the rents, and these are rented now, we've got tenants living in them. I met with the property manager today. She confirmed that they had underestimated the rent, and where that's good. I mean, some people pulled out on these because they thought the rent was too low. I thought the rent was too low, but when you've got a complex with 70 units in it coming onto the market at the same time, often the property managers will under-rent them to get them occupied, because you can, once you've got a tenant in there and they're happy, they'll typically stay for 2 to 3 years. So you're better to put them in at a cheaper rent and then put the rent up slowly over time. That's equitable. You're giving them notice. But on a low rental projection, because they were projecting rents before they received them, and now they're actually pushing them up, these things are cash flow positive by $5,000 a year. That's pre-tax. So that's $5 a week to $100 a week cash flow positive. So this is before tax credits, tax benefits. It's about 2Ks from the CBD. Maybe someone's measured it's only 1.5. I thought it was 2, but 1.5, 2Ks. And we have had huge, and we've been run off our feet on this project. In fact, I came back from my holiday early to meet clients, take them through, because I've got a lot of product knowledge on this project. We're about to hire a wonderful woman that's got more product knowledge than me. And it's just been a brilliant project. And I went there yesterday and saw more tenants moved in. I saw more people living there. And it's one of the best projects I've seen for a long time. So great project. It'll sell out quickly. If you're not on it, you should check it out and talk to one of our team around the country. Pretty much all of our salespeople are now completely up to date with this project. So talk to our team. Armour Street, the latest release. So these are 1, 2, and 3 bedrooms. I'm pretty sure that both 3 bedrooms are now. There's only two 3-bedroom units in the complex, but again, really well located within the 4 Avs. Settlement will be early next year, and these are cash flow positive, $3,500. They're closer to the CBD than the Fletcher's product. So one's not better than the other; they're different. The cash flow is lower on this, but the capital growth is expected to be higher. So it's all about balancing cash flow and capital growth. This is 1.3. The last one was probably 2 kilometres from the CBD. So this one is within the 4 Avs. The other one was just outside the 4 Avs. And we expect capital growth on these before settlement, because those prices for a CBD of a major city, in my opinion, is crazy. And the only reason that the developer is getting those prices is that they've bought the land so much cheaper than if they were buying it in Wellington or Auckland. So I think we released this week. So that's in Armour Street. Check those out. All the information's on our website, and you can get that in your own time. Now, jumping up to Auckland. Who said you can't buy cheap property in Auckland? Similar prices to those Christchurch ones for the 1-bedrooms, a bit more expensive for the 2s, but not much more expensive. Cash flow positive in Auckland, and with a $20,000 discount to market valuation, these are break even, $70 a week cash flow positive in Auckland, our New Zealand's major city. Now it's funny, I don't see these properties much on Trade Me, and it's because there are so many properties on for sale in Auckland that they get blended in with $1 million, $2 million, $3 million properties. And these are infill housing. These are Auckland Unitary Plan. So if you're a first home buyer, second home buyer, first home investor, or second or third time investor, it's pretty hard to stuff. It's pretty hard to stuff it up with prices like this, because most of the surrounding property in these types of location, 1960s, 1970s, single glazed, horrible houses that need to be demolished. Because one thing the great unwashed landlords aren't very good at is maintaining properties. They're not good at looking after them. And that's, I think, a crying shame with my social left hat on. It's not good enough. New Zealand landlords should be better than that, because they're looking after people's lives. You're living in a house, you spend a lot of time there, you sleep there. And when they're moist because it hasn't been insulated properly, that's not good. So anyway, these are brand new, double glazed, current latest building standards, latest product materials. These are very sophisticated houses, and they're brand new, and they're $450,000 to $615,000. Sunnyvale, Auckland, similar numbers. Again, probably a more expensive location, hence the cash flow is fractionally down. It's down from 3.6 to 2.1. However, we'd expect better capital growth here. The average for the last 10 years is 7.9 over the last 10 years. So this is the stuff you want for your cash flow. This is your portfolio builder. This is the stuff you should buy before you buy your capital growth property. And we still expect to get good capital growth from it. So that is me. I am just going to talk about a couple of other things that we haven't been very good at talking about. And the first one is our team. We were in furious recruitment mode before Christmas, and we are still in furious recruitment mode because we've got more customers than we can actually deal with. And I've probably never worked so hard in the last 12 months than the last 12 months. But I'm loving it. And because I love dealing with customers, I love property. I could talk about it all day. But we are under-resourced and we are looking for more people. But in the meantime, on our website, please click on our team page. And if you want any information on anything you've seen tonight, email one of the people in your location. We've got multiple investment agents in some cities. Others we've only got single people, and not single, but individual agents. So please email our team as opposed to me, because I'm currently hiring. We're hiring 4 people at HQ. We've hired 2. We're needing 2 more. So we are under-resourced at the moment. I'm just going to be upfront and frank about that. So if you do email me, I'll forward it to one of our team and they'll come back to you. How do you work with us? The first thing you do is you spend some time on our website. So we have a free online membership, and what that gives you is a lot of information. It gives you, I used to own 2 property education businesses. We've decided to make that aspect free. And that second point is something everybody should do, and it's request an investment capacity report online. It takes about 3 minutes for you to populate the information. You will get a 7-page report back from our business that will tell you more about your financial circumstances than you may have known. And at that point, we will engage one of our investment specialists with you, and they will then help create what we call a property matching report, which I believe is unique to New Zealand. I don't know anybody else that's doing it, and we will basically recommend properties based on your financial circumstances. And everybody's different, and every property is different, and not all properties are created the same. And when someone says, what's the best property? I go, well, there's no such thing. But the most ideal property for you is this one because of your financial circumstances. But the person next to them, it could be a different property because everybody's income is different. Everybody's equity is different. Everybody's cash flow is different. Everybody's age is different. Somebody in their 30s is a very different prospect from a bank's perspective than somebody in their 60s. So I have put my email up there. I want you to email me, but I'll probably reply and CC you into one of our team who will hold your hand, talk to you, help explain anything that I haven't explained very well tonight. And please, at worst, join our free membership option. There is a huge amount of free resource in there that we've spent a lot of money and time building, and it's only going to improve all year. So I'm going to stop talking for a split second and go to questions. I won't mute myself. I've got some more questions. Someone's asked me about Colombo Street. What do I think is the better capital gain, 1 bedroom or 2 bedroom? So this is a pretty easy answer, and it's a good question, Paul, and I get it a lot. If I look at product type, the world is downsizing. I mean, we just bought a 5-bedroom house, and I've already had one of my kids leave, and I'm already trying to talk my wife into buying a 3-bedroom townhouse in the middle of the city because I love it so much. And she looked at me and thought I was mad. But the reality is, I reckon in the next 12 months, we probably will sell and downsize. Now, that's the same for first home buyers, second home buyers, third home buyers, because most people in the world are downsizing. Smaller families, smaller houses, less cars, etc. So in terms of capital gain, if I put my old school hat on, I think 2 bedrooms would probably get a bigger capital gain than ones. However, in a complex like 350 Colombo, the most recent sales specify the next sale, if that makes sense. So I think for the next 5 years, it'll be pretty even. I think 1s and 2s in there will probably be evenly spread. there are more twos than ones, which is another reason I think the capital gains there will probably be bigger. And I can see a lot of owner-occupiers moving in there, and they're already in there now. And once that complex is up and running, I think it'll be quite popular. So on Colombo Street, it's right across the road from the Colombo in Sydenham, bus stop outside the complex. I think it's going to be a really popular little project for owner-occupiers and investors. If you're selling to an owner-occupier, the 2 bedrooms will no question be more popular than the ones, because you've got a bigger market as a second bedroom. So my gut feeling is for the next 5 years, if there was going to be a greater gain, it would be in the 2s versus the 1s. Gary's asked here, with regards to the Auckland market, would you consider an investment in new build terrace townhouse in a new developed neighbourhood to be a good investment? Yes, I would, Gary. I don't touch second-hand property anymore, apart from my home. And even then, I didn't really want to buy old. I wanted to buy new, but someone had spent near $1 million on our current house, but it wasn't built in the 20s. But when it comes to investment property, I wouldn't touch second-hand. So in Auckland, you've got some really, really exciting suburbs on the up. And that's our focus for the next 6 weeks, is to bring some more projects around Auckland. So please don't buy anything yet, unless it's one of the ones we've got on our website. We are negotiating with some developers at the moment, and we don't just go and get a listing. We spend about $10,000 on a new listing when we package it up, do the research, do the rental assessments, do the valuations, do the macro and microeconomics. We spend a lot of time before we accept a project. Not all developers and builders are created equal. And I think one of the things we do the best is stop people buying shit property. So if you're a new customer, please don't buy anything until we vet it, because something might look good on the outside and not so good on the inside, especially in Auckland, because the biggest city, and it has a powerhouse of good and bad builders. Somebody has asked, what do I think of first home in Rolleston from an investor point of view, 3 to 4 bed? So Rolleston was one of the areas, it's to the west of Christchurch. It's got a huge amount of money being spent on it. It was the fastest growing borough in New Zealand for a while. And there was a period where it was oversupplied with rentals and homes. Right now that imbalance is pulled back. It's probably equal by demand meets supply. So if you want to live there as a home, Rolleston's great. It's got a lot of amenities. It's got a lot of infrastructure spend going around it. We haven't got any stock in Rolleston at the moment because we're focusing on the CBD, and we're also focusing on the north. We think North Canterbury is probably more undersupplied than Rolleston at the moment, and I'm talking about Woodend, Rangiora, Kaiapoi, and we are in the process of packaging up some stock in that location. Now, if someone specifically wants Rolleston, we can get one-off deals for them, but we're not launching a 20-stage or 30-stage subdivision out there anytime soon. We'd probably do that in Lincoln or maybe Taitap, but we just think that there are other areas which make more sense now, but Rolleston is still a very safe place to buy. Another question from Chris, just about body corps. There's a lot. Chris has basically said there's a lot of misunderstanding about body corporates, and he is so right. Chris works in the industry, and body corporates are your friend. And if anyone tells you otherwise, walk away, turn off, start thinking about what you're going to do tomorrow. Anyone that says, "Oh, I don't buy in body corporates, they're nothing but a problem," are typically one-off investors that have had a bad experience and they've written it off. And it'd be like getting a brand new, Range Rover, and it's got a few things broken, and then never buying another one. It's not a reason not to buy. So, sometimes things go wrong, but on the bulk, body corporates are brilliant because one of my biggest criticisms of the New Zealand property investor market is the lack of long-term maintenance on properties. And as an emotional father who is about to say goodbye to his son to go to university in Wellington whilst we live in Christchurch, when he goes flatting in Wellington, I will be up there like Inspector Gadget looking under the floor, looking everywhere when he decides to go and rent a second-hand flat, because Wellington's cold in the winter. It's got earthquake risk on top of it. So I want him to be in a safe and warm and healthy property. And body corporates force that on the owners. They don't have a choice. So they're the way of the future. And it's, we're not the quarter-acre white picket fence, dog barking in the yard country that we used to be. It is changing. And I say that as a 51-year-old that has a fenced property with 2 dogs. I'm looking at townhouses where the dogs would be happy and living in a smaller bit of land that'll force me to take them for a walk in the morning and at night, because sometimes it's easy not to, they'll be okay, they'll run around the backyard. So good questions. So I'll leave this chat open for a bit longer, and then I'm going to shut it down. You've got my email address there, and we've got an amazing team waiting to look after you. And please join our membership. Please ask for an investment capacity report. These things are free. And what they will do is spark an engagement exercise with you. And hopefully at that point, we can help you get into property or add to your existing portfolio. We don't just do first-time investors. In fact, we've got a lot of customers that have multiple properties, but what we do there is help them balance their portfolio across the right locations, the right product type. I believe everybody should have houses, townhouses, and apartments in their portfolio. I believe every investor should have a geographical spread on their portfolio. And I don't do this out of opinion, I do this out of experience. Aucklanders are typically asset rich and cash poor. Central Otago people are asset rich and cash poor. Christchurch people are probably equal because it hasn't had the equity growth yet, but it's coming. Mark my words. So I'm just going to mute myself. Oh, I've gone back the wrong way. I'm going to mute myself and leave the presentation up for a bit longer, and just answer any other questions that come in the next few minutes. Otherwise, have a fantastic 2020. We're going to be, please keep an eye on your emails. We're going to have bus trips coming up. We're going to have retreats for Platinum members. Got a whole lot of exciting things that we can do with our team building. So hopefully see you at one of our property events soon. Thank you and have a great night. Okay, just before I sign off, Michael has asked a good question. Isn't Auckland for 449 better prospect than Christchurch at 405? No, Michael, it's not. They're different prospects. Sunnysnook is not in the similar location in Auckland to Armour Street. Armour Street, you can almost throw a stone and hit the cathedral. It'd be like comparing Parnell or Ponsonby equivalent. So they're very different. So price point wise, yes, there's only 50 grand or 45 grand there. However, the locations are remarkably different. Now, Sunnysnook is a great location in Auckland, but you know, you're not walking into the CBD, are you? So that's where it's about balancing capital growth and cash flow regionally. So depending on your balance sheet, I'd probably say they both make sense. And they're different because one's in Auckland with 2+ million people, one's in Christchurch at flat o'clock with expected rises and forecast 20,000 people living in the CBD. So just different. So I don't like the word better. So not disrespecting what you're saying, Michael. I'm just saying that they're different. But good questions tonight. So I'll be here for a couple more minutes, then I'll shut down. So if you've got anything else pressing, forever now hold your speak now or forever hold your peace.